China just pulled the trigger on the biggest economic stimulus since the pandemic.
Economists say China has unleashed a quote-unquote stimulus blitz. The country's central bank is leading the charge here. It is pumping more money into the economy. Loans are being made cheaper. One big area of focus is mortgage.
Remember those videos about the Chinese economy collapsing and then it never happened? Except it almost just did, but then it didn't because China just did one of these. They injected some liquidity into the system, and you remember what Robin Williams said about liquidity.
I talk to them about being like a group of junkies who've relapsed, going, listen, man, I just need some liquidity, you know what I'm saying? I just ran into some bad subprime, you know? We just had complex formulas. We just didn't factor in greed and panic, you know? I just need $805 billion by Tuesday.
We're talking trillions of yuan being pumped into their system, interest rates slashed, and banks given more financial liquidity and government support flowing into their real estate sector. And this isn't just a story about China. This is going to have a huge effect across the entire global economy, especially across US markets, which will have an effect on our investment portfolios. And that's because China is the world's second biggest economy, and if they sneeze, the rest of the world could also catch a cold. And the stimulus package could end up causing what people like to call a reverse market crash, where instead of the usual collapse people associate with crashes, we could see an explosion in asset prices. Meaning if you like to invest your money, your portfolio, and your 401ks could be affected. So in today's video, I want to help explain exactly what this means if you're invested in stocks and bonds and Bitcoin, and how this new round of stimulus will affect everyone. So let's get into it. What's happening in China's economy? China, the world's second largest economy, has been grappling with major economic challenges. After decades of explosive growth, things started slowing down significantly post-pandemic. Here's what's been going wrong. A collapsing real estate sector. Real estate makes up a staggering 30% of China's economy. However, this sector is in deep trouble. Developers like Evergrande, which was once a giant in the industry, are crumbling under the weight of unsustainable debt. Unfinished projects litter the country, and homebuyers have lost confidence, leading to what's known as a mortgage boycott, where people refuse to pay loans on incomplete properties. Deflationary spiral. Prices in China have been falling, a phenomenon known as deflation. While lower prices might sound good on the surface, deflation can poison an economy. Consumers hold off on spending, expecting prices to drop further. Companies make less money, wages stagnate, and the entire economy slows down. Debt overload. Both households and businesses in China are drowning in debt. The government's previous growth strategy relied heavily on borrowing to fund infrastructure and housing projects. But now that debt is becoming a major liability. Weak consumer confidence. Post-pandemic, Chinese consumers haven't bounced back as expected. People are saving more and spending less, further slowing down the economy. In short, China's economy is teetering on the edge of a recession. That's why the government is stepping in with a massive bailout. China's bailout plan, the key measures. The Chinese government has launched a series of measures to inject liquidity into the system, stimulate growth, and restore confidence. Here's what's included. 1. Lowering reserve requirements for banks. The People's Bank of China, PBOC, has reduced the reserve requirement ratio, RRR, for banks by 0.5%. This move frees up around 1 trillion yuan, approximately $142 billion, for new lending. In simpler terms, banks now have more money to lend to businesses and households, which could kickstart economic activity. 2. Interest rate cuts. The PBOC has also slashed interest rates. Homeowners with existing mortgages will see their rates reduced by 0.5 percentage point. For context, if you're a homeowner in China with a $400,000 mortgage, this cut could save you tens of thousands of dollars over the life of the loan. It's estimated that this measure alone will save 50 million households around 150 billion yuan, 21 billion per year. 3. Stock market support. The government has committed 500 billion yuan, 70 billion, to support institutional investors, like insurers and funds, to buy more stocks. Essentially, they're trying to prop up the stock market by making it easier for institutions to access liquidity. 4. Corporate share buybacks. A new 300 billion yuan, $42 billion loan program is being introduced to help companies buy back their own shares. This move is designed to boost stock prices and restore investor confidence in the market. 5th, stimulus for the real estate sector. The government is funneling more support into the struggling property market. From cutting mortgage rates to offering financial aid to developers, the goal is to stabilize the sector and prevent further defaults. 6th, infrastructure investments. China is also doubling down on infrastructure projects, pouring money into high-speed railways, airports, and urban developments. These projects create jobs and stimulate economic growth in the short term. What this means for global markets: China's bailout isn't just a domestic story. Its economy is deeply intertwined with the rest of the world, and its actions will have a ripple effect globally. Here's how. 1. Commodities are on the rise. China's stimulus measures are driving up demand for raw materials like copper, aluminum, and steel. For example, copper prices surged over 5% in the week following the stimulus announcement. This is great news for commodity-producing companies and countries that export these materials. 2. Boost to U.S. stocks. Historically, major stimulus efforts in large economies have lifted equity markets worldwide. U.S. stocks, particularly those with exposure to China, could benefit. For example, ExxonMobil, a commodity-driven company, saw its stock rise 4% in just 1 week. Freeport-McMoRan, which deals in mining gold and copper, jumped 8% in 1 day. 3. Crypto momentum. Every time a government prints money, concerns about fiat currency devaluation rise. Bitcoin, with its fixed supply of 21 million coins, often benefits in such scenarios. In fact, Bitcoin has already started climbing, partially fueled by China's actions. Increased global growth expectations. China's bailout could stabilize its economy, which would be a positive signal for global growth. Companies and industries that rely on Chinese demand, from luxury goods to tech, could see a boost. What should investors do? If you're an investor, China's bailout presents both opportunities and risks. Here's how you can navigate this. 1. Look at commodity stocks. With commodity prices rising, this could be a great time to invest in companies tied to raw materials. Energy companies, mining stocks, and steel producers are all worth keeping an eye on. Stocks like ExxonMobil and Freeport-McMoRan could continue to perform well. 2. Diversify globally. China's recovery could benefit companies and industries around the world. Consider investing in ETFs or mutual funds with exposure to international markets, especially those tied to Asia. 3rd, hold dividend-paying stocks. In times of asset inflation, companies often pass on gains to shareholders through higher dividends. If you're looking for steady income, focus on high-quality dividend stocks. 4. Consider Bitcoin. For those comfortable with crypto, China's stimulus could provide another reason to hold Bitcoin. The narrative around fiat currency devaluation could gain traction, pushing Bitcoin's price higher. 5. Stay cautious. While stimulus packages can boost markets, they also come with risks. Asset prices could inflate to unsustainable levels, leading to bubbles. It's important to stay diversified and not chase short-term gains. Lessons from history. This isn't the first time a major economy has rolled out a massive stimulus package. Let's look at 2 historical examples. 1. The U.S. in 2008. During the financial crisis, the U.S. launched the $750 billion Troubled Asset Relief Program, TARP. This stabilized the financial system and led to years of asset inflation. Stocks, real estate, and even luxury goods saw significant price increases. 2. The Eurozone in 2012. The European Central Bank introduced aggressive monetary policies to stabilize struggling economies like Greece and Spain. That year, the U.S. stock market rose 13.5% due to spillover effects. The takeaway? Stimulus packages often lead to asset inflation, but they also increase the risk of bubbles. The risks of China's bailout. While there are opportunities, China's bailout isn't without risks. Debt overload. China's bailout adds to its already massive debt. If the stimulus fails to generate sustainable growth, it could lead to a debt crisis. Asset bubbles. Pumping liquidity into markets often inflates asset prices. If these prices rise too quickly, they could collapse just as fast. Global competition. If China's stimulus leads to higher commodity prices, it could hurt countries that rely on imports, including the U.S. political tensions. China's growing economic influence could exacerbate tensions with other major economies, particularly the U.S., which could impact global markets. Final thoughts. China's bailout is a big deal. It's a lifeline for their economy, but its effects will ripple across the globe. For investors, this presents both opportunities and challenges. The key is to stay informed, remain diversified, and focus on long-term strategies. As always, the future is uncertain, but understanding these developments can help you make smarter investment decisions. What do you think about China's bailout? Will it stabilize their economy or lead to new risks? Let me know your thoughts in the comments below. If you found this analysis helpful, hit the like button, subscribe, and stay tuned for more insights on global markets. Thanks for watching, and I'll see you next time.